Hello traders, Cousin Vinny coming to you from theclosingprint.com on January the 10th, 2016. This will be our first video of the new year. I'd like to say Happy New Year to the followers that have watched our videos over the last 5 years. In this video we'll cover the indices which are entering correction territory, obviously. If you've been watching over the last week, the S&P 500 was down 5.96%, and the other indices, as you can see, were greater than that. Tick and tick cumulative for the NASDAQ and the NYSE were both lower, but oddly enough they are diverging. They aren't making new lows. We'll try to figure out what to make of that. NYSE and NASI for both the NYSE and the NASDAQ are both negative and near extremes. We would consider that an area where we might see further downside on breadth, but possibly a change in direction, maybe a dead cat bounce in the week ahead. Breadth, no MADs or MDDs, but we were very near -9 to 1 on several days last week. The NYAD is trending lower, as you would expect. Breadth continues to deteriorate. The put-call ratio is in the buy zone. It's greater than 1. It's actually at plus 1.40. Intraday, it was a little bit higher. Closed at about 1.34. VIX is in the fade the fear territory if you watched my video or you read the section of the book. Currencies, US dollar hit a high at 99.75, closed at 98.60, making higher lows and still in an uptrend. Over the last year it's put in a ascending triangle, so we'll be watching that. TLT is higher on the daily and the weekly as investors move to safety. VBTX is the fund that we use. UST SPX, the bond stock ratio, also echoes that flight to safety into bonds. It's bearish. You want to check out banks. They looked absolutely horrific last week at lows with humongous volume. Commodities, crude oil is lower, as everyone knows. Copper is lower. Gold was higher, but silver was flat. So gold, again, that's a flight to safety. Utilities was the only sector with strength last week. IYT is in bear market territory, greater than actually 25%. That's a typo. And setups is really nothing to see in the IBD 50, but we will be watching that in the week ahead and posting setups as they might appear. Here is the S&P 500 monthly chart that we posted over the last week. We noted that these Fibonacci levels are areas that we are interested in. The lows from 2009 to the present, a 50% retracement would put us right around the 1875 to 1850 level, which is certainly in the cards considering where the indices are recently. If you take the Fibonacci pivots from the March 2009 lows up to the recent highs, the 382 is all the way back to the 1585 level, more or less. The 236 level is right in that zone between the 618 and the 50% levels. So they all converge in this area at this trend line. So do we see a straight shot down to this level? No one knows. However, with the price action below the 10-period simple moving average, that is a sell signal since December. Now, if you read our blog post, you know what we thought about that. Just check out the blog and look at the previous weekend blog post as well as all week. Last week we were mentioning the S&P 500 on a monthly basis. Okay, MACD continues to move lower, and we'll watch for a dead cat bounce this week. If we look at the S&P 500 on a weekly basis, we see this rounding top that's reflected in the bond stock ratio in the lower panel. This is the UST, the 10-year to the S&P 500. that a lot of people follow. When it's in a downtrend, the 65 period moving average here, that is bullish, obviously. It mirrors what we're seeing here. As fewer investors are interested in a flight to safety, they're more interested in trading equities. So this ratio and this moving average will drop. Now, we've mentioned over the past year that this started to flatten. We saw that in summer, right before the big drop in August, as well as the 5200 death cross. And now we see these highs here where we were testing the first week of January. So this could continue to move higher as more investors move to safety. This could inflect here as well if we get a dead cat bounce. And finally, here is the S&P 500 on the daily time frame. You can see there's really nothing in here as a support level between 1920 and this level down here at 1867. So we could shoot down here sharply on Monday, Tuesday, perhaps put in a hammer and then have a dead cat bounce. We have some trend lines here where we could bounce and retest, but I would expect that we're going to see a dead cat bounce and then a rejection at previously lost support turned resistance now. If we zoom out on the daily, we can see some levels here at 1904 that we traded in 2014. Perhaps we bounced there. Okay, and then you see these tops here at 1897. So that's another intermediate level before we hit these lows that we saw last year in August and September. So here is the comp NASDAQ composite. We can see the 618 level. There's a possibility that we could bounce there, or these lows down here at 4500, 4475 or so. And here is the NASDAQ 100. You can see that 618 level from these previous pivots, this low at 4053 up to that high at 4737. A reverse Kirby here. If you've read my book, this section, you can see why prices accelerated to the downside so quickly. I would expect a dead cat bounce now that Stowe is in the green zone. We're watching the NDX 850R. That's the number of stocks trading above their 50-period moving average is at 8. That's an extreme level. Again, that's another level that shows us what we could possibly see a turn to the upside. And note the volume. And of course, the Russell 2000 RUT looks absolutely awful. We are in the green zone on Stowe, and MACD is in an extreme. We could see that continue to move lower. We'll watch for a shorter histogram bar on the daily chart. This really looks quite bad, but we've spent 3 days outside of the lower Bollinger Band, so I would expect that we should start to mean revert at some point. Hopefully it's this week for those of you who are looking for a bounce to get out of some of your shares that missed the turn in December, which we pointed out on the monthly chart of the S&P 600 small cap index. We're losing that level right now. We have a 236 level from these March 2000 lows up to recent highs, so we could see a bounce in this area as well. This is the lows back in October of 2014. That was the Ebola scare. So watch for a bounce back up to the 10 SMA. I would expect that we might get rejected there again if we don't see a catalyst over the next few weeks to push the indexes higher. I completely expect that we're going to enter into a bear market in the near future, only because we've come a long way from the 2009 lows to where we are presently. We moved sideways, and a lot of institutions were keeping prices up here, in my humble opinion, getting out of shares, and now they're going to let this fall. A better area would be down here in the 382 or the 50% retracement, which would bring us all the way back to the 460 level, more or less. So that's not out of the range of possibilities. And of course, the S&P 1500 composite. This is composed of the S&P 500, the S&P mid cap 400, and the S&P small cap 600. This has been on a sell signal, as you can see here. This is the histogram of the high to low percent. This gives us a buy when it's above the zero line and pushes through this level here. You see this horizontal line, and a sell when it drops down below the zero line. Very effective, simple indicator. Now we are trading outside of the lower Bollinger Band for 3 days, 4 days now. Last week we could see a mean reversion back to this trend line in the short term and a dead cat bounce. Finally, this is the New York Stock Exchange composite of more than 2,000 stocks. We are at lows that we saw back in August, so that's something we'll be watching this week. I would anticipate that we might see a dead cat bounce, as I've mentioned previously several times now in this video, as we could see a bounce here back up to some support levels and then a rejection if catalysts do not appear to push the indexes higher. So here is NAMO, a simple breadth indicator. The net advances, which is the accumulated advancing issues minus declining issues, which gives you a reading where we're at an extreme on the NAMO, the McClellan oscillator for the NASDAQ. When we reach these levels over the next 5 to 10 days, we can expect this extreme to hold and prices to reverse. So that's another indicator that we're watching for possible turns in the market. You can see that we're putting in lower highs and lower lows on the summation index. If we look at the advanced declining issues, we can see a negative bias here again, mostly below the zero line. NYMO, NYSE for the New York Stock Exchange, same thing, we're looking for extremes. We haven't yet seen the extreme that we saw in December. We had an intraday reading of minus 107. We continue to put in lower highs on the New York Stock Exchange. The green area in this mid panel is the New York Stock Exchange composite. And of course NYSE continues to move lower. So we want to see this turn back up a higher low. Remember, the New York Stock Exchange composite is already at the August lows. Here is the VIX. We are definitely in a fade the fear territory. If you recently downloaded the premium video on our premium section in the blog, remember this is case sensitive. Under the premium video section, we uploaded a fade the fear video number 9 in the series. And this is quite appropriate for this time period when the markets are at extremes and you see fear and volatility spike to the levels that we've experienced over the last week. We are anticipating a fade the fear moment here and a short-term bounce. CPC, the put-call ratio, shows us the same information. We're at extremes. We've seen previous times where we've been at these levels. That was market inflection points and prices moved higher. So expect to see something like that with the NYSE at the August lows already. We close off of those lows, as you'll note here. And we'd like to see at least a blue elder stick, preferably a green one, but we'll take what we get this week for a little bounce. If you were following my stream on Friday evening, I took VXX puts at the end of the day. As you can see, we saw these wicks on these candles. We were anticipating that we could see a fade the fear moment. So we scaled in to the VXX puts. I believe they're the January 16, the monthlies. We've got like 2 weeks left. And if you're trading UVXY, we have similar thoughts here. We're at extremes. You could draw a trend line through here. We see previous levels at 49.60, just overhead, so there could be a short amount of pain here. We could see a great deal of pain. Things could really escalate very quickly. No one really knows what's going to happen on Monday, Tuesday, but we are reaching a level that we've seen reversals in the past. So we took a little bit of risk, we defined our risk, and we know where we will be wrong. If this continues to move higher, we'll stop out and we'll just sit on the sidelines and wait for a better setup. The dollar, as we mentioned previously, we've seen this high here at 100.71 hold. We're putting in higher lows. This is an ascending triangle of sorts. Also could draw in a horizontal line here, and we could argue that this is in a sideways range for the most part. We're watching these higher lows, this trend line of course, and this lower Bollinger Band. The 200 period is below. MACD's positive, but a lower high presently, as well as STO moving off the red zone, and Copac is turning down as well. So watch the US dollar this week, as well as bonds, where we mentioned TLT was moving sideways continuously since July or so, trying to break out of this trend line on Friday. You can see that move higher, flight to safety again being presented. We're in the red zone. MACD is trying to stay above the zero line. We're looking for a continuation or a little rejection here at the upper Bollinger Band. Over the short term, we'll probably see a little move back to the 10 EMA, but longer term, I think we're going to continue to move higher as the markets continue to correct. And as we mentioned, we took a position in the VBTIX, a Vanguard Total Bond Market Index Fund. It's an institutional fund. We're right in around this area. We took a position on Tuesday, so we had a defined level of risk, and we in fact moved in the direction that we anticipated. So we're looking pretty good on the bond positions that we have. So for the present time, we have a position in bonds, but no position in long equity funds. Commodities, we mentioned copper is lower. With the slowdown in China, we are anticipating that this will continue to move lower. We could find a bottom here, but there's really no catalyst for a move higher in the short term on copper. Now we look at gas, unleaded, new lows as you would expect with crude oil making new lows. Gold had to move higher as we expected again because of the flight to safety issues. Nice volume here. Continue to see possibilities of gold running back up to this volume by price band. And then of course crude, WTIC, we're making new lows. So what are we looking at this week in terms of setups? If we look at the sectors, everything is oversold. As you can see here, we have Stochh RSI enabled. This is a 2-month time frame for each of the sectors. As we mentioned earlier, IYT is in bear market territory, continues to move lower, off by 25%. STO is in the green zone, MACD is at an extreme. So that could turn and see a short-term bounce back up to this trend line on the transports. Think of UPS, FDX, etc. Let's take a look at those. Here's FedEx, inside day on Friday, seeing some buying volume. STO is in the green zone. So watch for these. Don't jump into it first thing in the morning saying, well, Vinny thought this or that. You need to see confirmation. UPS, same thing, in order parcel service at lows. We could see it move back up to the 10 period EMA, but with the 10 below the 30, remember the book, that is a short only. When prices move back to resistance and get rejected, that's where you take your short. So anything from here moving higher is counter trend. MACD is really on a mission lower, and STO is in the green zone. Airlines are typically associated with the transports as well, as you would expect. Spirit Airlines, a favorite with the millennials. Note we're breaking down below the 30 period moving average. The 10 period is crossing over. Volume isn't that great, but MACD is turning down as well. This might be a short, or we might see a little bounce here at this zone. So watch for something to happen on airlines. Let's take a look at ALK. Same thing here, losing support on Alaska Air, which has been on the IBD 50 off and on for some time, looking pretty bad. Bear flag on Hawaiian Airlines. This is one that Russell was looking at taking short at this level. I think he did. MACD below the zero line, and STO is in the green zone. Railroad, same thing. CNI, Canadian National Rail, at lows. We saw a little 2 dojis here. Maybe we see a big bar on Monday, Tuesday. Note STO's already starting to turn. CSX, another railroad, broke down out of this ascending triangle, continues to move lower. So now we have lower highs and lower lows. Look at the volume. and MACD. Now, speaking of volume, let's take a look at the banks and financials, which look pretty horrific. Note the volume. Most of these look like shorts, though we could see a short-term mean reversion on a lot of these. Aflac, Allstate, all of these are in the financials. AXP, AIG, American Tower, AMP, and so on. You can see this trend here, and if we get to Bank of America, that's another one that you can, Avalon Bay looking okay. Bank of America, tremendous volume here on some of these names. Bank of New York Mellon, the banks really got clobbered over the last several weeks, though many of them are in the green zone on Stowe. MACD could turn and we could mean revert quickly back up to lost support and get rejected there. For the most part, banks look horrific in my humble opinion. Berkshire Hathaway at lows, BlackRock, so on and so forth. You can see the pattern here. No surprise, all of these financials are looking pretty bad. That's great, Vinny. So you've depressed me now. So what looked good last week? Well, utilities actually had a pretty decent week. AES, note the move off of the lows here, a little wicks on these candles. AGL, let's look at some of these names real quickly. They're showing relative strength, moving higher as the indices have been moving lower all of that time. Okay, Con Edison moving higher. Dominion Resources moving higher. DTE, not so good. So I'm just going through these real quickly. You can pause the video and check these out. Duke, pull these charts up, maybe take some notes. EXC moving higher. First Energy looking okay. ITC moving higher. This is one that was on the IBD 50. Grinding higher, trying to break out here. MACD still positive. Nextra Energy, nice source. You see the pattern. So check out the utility sector. We happen to have all of the sector components set up. You can see right here, XLU sector, utilities. That helps us to scan these sectors very quickly. We can also run a scan to see what's working relative strength wise. Maybe we'll do that and post some charts later on. But for the most part, energy looks the best. Just keep an eye on these stocks for possible entries. Remember, they pay dividends. Maybe you want to put some money in here on stocks that look good, and you can go from there. Okay, so that's going to do it for me for the weekend video. This is Cousin Vinny coming to you from theclosingprint.com. For you new traders looking for a way to perfect your trading, you can look at it as insurance. It's available in several different formats. We will put this in a hardback and a paperback version at some point in the near future. This will help you out a great deal. It's only $24.95, no big deal. It's definitely worth the money, in my humble opinion. Take care, and we'll see you on the stream on Monday.